topic focuses on multivariate empirical methods and performance persistence within alternative investments. The topic examines statistical techniques used to analyze complex return patterns, identify hidden risk exposures, and evaluate investment manager performance. Alternative investments often involve nonlinear returns, dynamic factor sensitivities, and evolving correlations that require more sophisticated analytical tools than traditional single-factor models. The program emphasizes that empirical methods help investors better understand portfolio behavior, manager skill, and sources of risk across changing market environments. These approaches are especially important in hedge funds, private equity, and managed futures because alternative strategies may contain leverage, illiquidity effects, and hidden systematic exposures that are difficult to observe directly. A major topic within the topic is principal component analysis, PCA, a statistical method used to reduce dimensionality and identify the primary factors driving portfolio returns. PCA transforms correlated variables into a smaller set of uncorrelated components called principal components, each explaining a portion of total return variance. The program explains that eigenvalues represent the amount of variance explained by each factor, while eigenvectors identify the structure of the relationships among variables. Investors use PCA to simplify complex datasets, detect common risk drivers, and improve portfolio risk analysis. PCA is particularly valuable in alternative investments because it helps uncover hidden exposures and systematic relationships that may not be immediately visible through traditional asset classification frameworks. The topic next examines multi-factor models and regression analysis, which are widely used to estimate portfolio sensitivities to different risk factors. Multi-factor models extend beyond single market benchmarks by incorporating variables such as size, value, momentum, interest rates, credit spreads, and macroeconomic conditions. The program discusses regression techniques used to estimate factor loadings and evaluate manager performance attribution. An important concern within regression analysis is multicollinearity, which occurs when independent variables are highly correlated and make coefficient estimates unstable or unreliable. The topic also highlights overfitting risk, where models become excessively tailored to historical data and lose predictive power. Effective multi-factor analysis therefore requires balancing model complexity with interpretability and economic relevance. Partial autocorrelations and regression diagnostics are another important component of the program. Autocorrelation refers to relationships between current returns and prior period returns, while partial autocorrelation isolates the direct relationship between variables after controlling for intermediate lags. The topic explains that appraisal-based valuation methods and illiquid assets frequently produce serially correlated returns because reported values adjust gradually to market changes. Investors use regression analysis and partial autocorrelation techniques to identify smoothing effects and better estimate underlying economic volatility. Understanding autocorrelation is especially important in real estate, private equity, and hedge fund performance analysis because smooth return data may underestimate true portfolio risk and distort diversification benefits within broader institutional investment portfolios. The program also explores dynamic risk exposure models and approaches for modeling changing correlations across market environments. Alternative investments often exhibit nonlinear and time-varying relationships with traditional asset classes, particularly during periods of market stress. The topic discusses several techniques for capturing these changing exposures, including dummy variable approaches, separate regression models, quadratic models, conditional correlations, and rolling window analysis. Conditional correlation modeling evaluates how relationships between assets change under specific market conditions, while rolling window analysis measures evolving sensitivities across different time periods. These methods help investors understand how diversification benefits, factor exposures, and portfolio risks may shift dynamically rather than remain constant over time, especially during financial crises or periods of elevated market volatility. The topic concludes by examining multi-factor approaches to fund classification and evidence regarding performance persistence among alternative investment managers. Multi-factor analysis can group funds according to asset classes, investment strategies, market-wide exposures, or specialized risk factors. Investors use these frameworks to improve portfolio construction, manager selection, and diversification analysis. The program also evaluates whether strong historical performance predicts future success. Research on performance persistence produces mixed conclusions because successful managers may experience strategy crowding, changing market conditions, or declining alpha opportunities over time. Persistence analysis often examines return correlations, risk-adjusted performance measures, and portfolio rankings across different periods. Ultimately, the topic emphasizes that empirical methods provide valuable insights, but must be combined with qualitative judgment and careful interpretation when evaluating alternative investments.